understand because I heard, I'm gonna let you to introduce yourself just because I see a couple of new faces here. So just name and how long you've been doing this.
Time Bissell, 3 months.
3 months? Okay.
David Shablian, month and a half.
Oh, nice.
Cynthia Truelove, just over a year.
Oh, great.
Just over a month, Jeff Ducey.
Okay. And you? Oh, I love you much.
I would be gone but I wasn't done with lunch. I'm 15 years.
Okay.
And former managing broker, former productivity coach here,
Nice.
agent, and now a team leader of my own team.
Okay. Do you mind to share with us how, for you, how the market has changed with the mortgage loan since you start and how you can see the difference now, especially after COVID?
Well, so after COVID, a few things happened. The first thing was that all the lenders started really pulling back on what they were doing. I mean, what went from, it was getting a little bit loosey-goosey, and it now is just high as a drum. High credit scores became exceedingly important, and it got more and more difficult to get VA and FHA loans. The other thing, and that's tied into that, is in this market, which is a really strong seller's market, a lot of multiple offers, it's hard to go up against a cash or a conventional deal.
Correct.
When you've got a buyer that's looking for an FHA or VA, especially if they're looking for the sellers to contribute closing costs. So there's but on the other hand, the interest rates have been so amazingly low, it's been driving a lot of sales, but they're supposed to go up this year. Yeah, I heard above 3%, but probably not above 4%. Are you kind of with me on that?
Yes.
Okay.
So, I'm sorry, Pat, I thought you were finished.
No, I am finished.
So, one of the things that we found is that a pre-approval, and this ties into what you wanted to talk about. Their local bank pre-approved them for over 215,000.
Okay.
By the time they took into account the fact that her employment was interrupted by COVID, it went from 215 to 2 to 185 to 160 to 145. Okay, so that was with the bank and a pre-approval and trying to work with the banker and everything else. And luckily we were able to get her financed otherwise, but that's a huge difference.
It is.
You know, in terms of what it was gonna cost, and she had a set amount that she could put down. And there was no wiggle room on that. So, you know, that pre-approval letter was worthless. Worthless.
Yeah. So, and we're gonna talk about that. There's a lot to talk about today, and we're gonna talk about pre-approval versus pre-qualification, because you have to be very careful with pre-approval and pre-qualification. What happened is, and I worked for Bank of America for 4 years, and what happened is Quicken Loans and Bank of America, West Fargo, and all these big banks, what they normally ask to their borrowers is, okay, go online and fill out the application. The system itself will provide the pre-approval letter to the client. So most of the time, we don't know, when we are clients, we don't know how to calculate our income. And I think that will be another very good class for you guys, because it's very important. When I called the realtor and I said, I'm so sorry, but your client doesn't qualify for X amount of money. And right now, because of the market, it's hard to find a 200,000 purchase price house. That's almost impossible right now. 200,000,
Good luck on that.
Yeah, exactly. So it's hard when I have to call the realtor and say, I'm sorry, but with Bank of England, and this is something I really love, we are very cautious with what we're using for income, employment verification, and the only reason why is because we want to close 100% of our deals. If I'm not at least 95% sure that I'm gonna close your deal, I would prefer to say, I'm sorry, this is not the moment for your client to buy a house. Or the higher I can go is 200 or 220. Why? Because after COVID, and we're gonna also talk about what the DTI ratio is, DTI debt to income ratio. Before COVID, we used to go with FHA, we used to go up to 52, 53%. Now we cannot go higher than 48. And that's now, today, when last year on March, about the same time, we couldn't go higher than 45%. So it was even harder to qualify a person. Conventional, still, we cannot go higher than 45% on DTI ratio, debt to income ratio. So a lot of things has changed, and this is very important for me as a loan officer to you understand, because believe me, I want to close all your deals. I work on commission as well. I do not have a so, and I need to put food on my table. So I want to close all your deals. I want all your clients buying a $500,000 houses.
We'd love to have those $500,000
Yeah, right?
clients.
But I don't want to waste your time. The borrower is risking the earnest money deposit if we don't do our job. So sometimes you will see me, if you work with me, you're gonna see me taking longer to give you a pre-approval. And I know and this, especially now with the market, sometimes it's not easy to wait. But if I'm requesting documents from the borrower and they are not sending the documents to me, not all the time I will be confident to send you a pre-approval letter if there's something that make me think this is not gonna work, or I really need to verify or double check that this person is really like bonus, overtime, commissions. We can only use it if the borrower is been getting those for the last 2 years, consecutive 2 years. 2 jobs or second job, full-time job and part-time job, only if the borrower has been in the full-time and part-time job for 2 years. We cannot use if the borrower has been in the full-time job for 3 years and the part-time job for a year, we cannot use the part-time job. So if your client cannot prove to me that he or she has been in that part-time job for 2 years, I'm sorry, I'm not gonna do it. Because you don't want to get in a deal that at the end is not gonna work. You're gonna hate me. I don't want you. So this is very, very important. That's why when I talk to you in person, one-to-one, I will always be sure that you understand where I am with that pre-qualification or pre-approval letter. We normally do not send pre-qualification letters. Once your client fill it out the application, I personally will take care of that pre-approval. I will review every single document. I will call your client and ask more questions if I need more information. My system is not doing itself.
What the heck is that?
So that's the AC. We have several different units up there, and it's switching between the units.
Okay, so let's start with some basic things. And the mortgage industry, we do have two different kind of mortgage. We know the qualified mortgage and non-qualified mortgage. This is very important for you to understand, because sometimes you have people that is self-employed and obviously they are not filing enough income on their taxes because they are making, or the company is making $300,000 on gross, but on net they are saying they are having $12,000 a year in net income. So we have to go by the net. We don't use the gross, okay? Sometimes you can have people with no taxes at all. They are not filing taxes at all. Sometimes you can have international buyers. Sometimes you can have people buying because FHA and conventional loans have limits. So depend on what city and county you are, every mortgage loan has limit, a max limit of the amount you can buy. So if that mortgage loan will exceed that limit, that's a completely different mortgage loan, okay? So qualified mortgage means all the mortgage that are under the guidelines of Fannie Mae and Freddie Mac, okay? Non-qualified mortgage, they are out of those guidelines. They are like independent mortgage loans, kind of things. That's the best way to explain it. So what a qualified mortgage are? FHA, it's a qualified conventional loan, VA loans, USDA loans. These are qualified mortgage. We have to go yes or yes by Fannie Mae and Freddie Mac guidelines. Then we have non-qualified mortgage. We do have programs as jumbo loan. This is the one that we're gonna use if the purchase price is, or the loan, it's higher than the limit per area. We have a bank statements program. These programs normally are more expensive based on interest rate, closing costs, down payments, requirements. They are normally more expensive. So we have bank statement program. We have foreign loans for people, international people coming to buy either a vacation home, an investment home, sometimes, a primary home because they are moving temporarily to United States. We have I-team program. I-team, it's for people who doesn't have a legal paper to work in United States. The IRS, and this is very funny, but I'm not the one who makes the rules. Okay, the IRS is gonna provide them with this I-team number to pay taxes, but they are not allowed to work. Do not try to understand that because I have. But they can still buy a home. They will need 25% down payment. And the interest rate right now is between 7 to 9%. So those type of things happen with this non-qualified mortgage. We can have another class to talk about all these because it's too much. Okay, very, very important, and we're gonna talk more about FHA and conventional loans because VAs are not that common. USDA in these areas, these are rural areas. There's a map. The map is getting small every single year. So we're gonna talk in another class about this as well. So FHA and conventional loans, and this is something that I want you learn today. Sometimes people got confused between FHA and down payment assistance for first-time home buyers. So two things that I want to be clear today. FHA has a DPA, which stands for down payment assistance. Conventional has it as well, okay? First-time home buyer. The first-time home buyer means the person is buying a primary home, okay? You can buy a primary home how many times in your lifetime? 5, 10? And you still can go from one FHA to another one. You cannot have do FHA at the same time. But let's say you have an FHA now and you want to move to a bigger house or a smaller house for whatever reason, or you want to move from Englewood to Sarasota. If you are selling this house, you can buy with another FHA because you're getting out of this one. Now, if you decided to rent this house, you cannot buy with an FHA. You have to use a conventional. Conventional loans, you can have up to 10 loans at the same time. Okay? Now, FHA loan, it's not a government loan. A lot of people believe FHA is a government loan. FHA is a loan insured by the government. What that means is the guideline says every person coming to a loan with less than 20% down payment has to pay a mortgage insurance. Okay, so the insurance company for FHA is from government. The one for conventional is a private insurance company like State Farm. They do have other names, but kind of the same thing for your auto loan. Okay, so that's the difference between FHA and conventional. Neither one of those are government loans. Okay. Then DPA, those are government loans. And borrowers can use it just one time in their lifetime. They cannot use it more than once. So if you have an FHA with, and you didn't, it's like kind of like the VA most of the time that they can use it just one. If you have an FHA, you didn't use the down payment assistance and you want to use it, you can use it to buy another house. However, if you already use it here, you cannot use it anymore. I do have a father and son buying a house right now and they are using DPA, and I talked to the son and I said, listen, I have to let you know, in the future, if you want to buy your own house, you won't be able to use DPA for the rest of your life because it's a one-time use. Okay? The DPA, down payment assistance, is okay. The government will give you a second loan to be used for down payment and closing costs. Okay, you cannot use that money to pay for your debts. You cannot use that money. You're not taking money. They are not giving you a check. If for some reason, because we're gonna talk about that later, for some reason there's some money left, they will apply it to the principal of your loan. Okay, so DPA, down payment assistance, or government assistance for all those people that do not have enough for closing costs. Let's say, and I thank you for mentioning the closing costs or seller concessions. If your borrower, if your client has only enough money for down payment, we can go with the DPA if they haven't used it. Do not say no to anybody. Send them over to me. Let me talk to them because I can ask all the questions. Once I start talking with the people, believe me, I know what questions I have to ask. So if they do not have enough money, and right now, sellers are not helping with closing costs at all. I mean, they are asking for overpriced and they are not helping with closing costs. Do not say, oh no, you need more money, you need to save more. No, let's talk to them. Because if they haven't used the help from government, we can use it. Okay?
They have a special requirement to use it?
You have to qualify, but you have to be buying your primary home, cannot be second home, cannot be investment home, but you have to qualify. DTI rate is a little lower, depends on credit score. So 640 is the minimum credit score to qualify for a DPA. From 640 to 680, we can go up to 45 DTI ratio. 60, 80 and more, we can go up to 50% on DTI ratio. So I love that question because this gives me the opportunity to tell you every single person is different. These are just basic things. Once I start exploring on people's financial situation, believe me, it's a completely, every single person a completely different world. I cannot tell. I always say a mortgage loan is like a fingerprint. You're unique. Okay? So let me talk to the people. Let me ask the right questions. So, yes.
They just said connected.
Oh, sorry, I thought somebody have a question. Okay, so, because it's a loan, the house will have a second lien. Okay, it's 2 loans, 2 liens in the house. So, if you want to buy, if in the future, if you're using the DPA and in the future you want to sell the house, you want to refinance your loan, you want to get a home equity line of credit, depends on what DPA you're using, you have to pay back to the government first. Because any bank in the world wants to be third in the line of liens. What happens is if for some reason you lose your house and the insurance company have to take over, because that's what the mortgage insurance does, they are gonna pay in order who is first in the first lien, the second lien, and most of the time there's not enough money for the third one. So there's not a third one unless you have a open permit on the city or whatever. So there's not bank in the world that want to be second or third in the line. That's why you have to pay back to the government in order to clean that position and have the HELOC or whoever is next in that line. Make sense? Okay. So FHA has, right now, as I told before, we are now working with people with less than 620 for credit score. That is not happening in this moment. Doesn't look like it's gonna change soon, unfortunately. So minimum credit score is 620. Okay. For DPA, this is for FHA and conventional. Okay. For DPA is 640 is the minimum credit score, and FHA requires 3%, 3.5% down payment, and allows the seller to hold up to 6% on closing costs. I know that is not happening. 6% on closing costs. Okay. DPA, same thing, because basically those requirements are based on the primary mortgage. Conventional, same thing with conventional, 620 credit score, could be 3%, and I love that one, or 5% as a minimum down payment, and allows the seller to hold up to 3% on seller concessions. Okay, those are like basic things important for you to know. Okay, FHA as agent, you know, they are very picky with inspection, appraisals, and you have to watch for those houses to be sure they are gonna pass, especially the appraisal. Okay. FHA right now, it's more expensive loan because of interest rates, because closing costs, they charge the PMI a year in advance. So it's a little more expensive. You will see the closing cost is actually a huge difference between FHA and conventional loan. Okay, right now DTI ratio again depends on credit score. For more than 700 credit score, we can go up to 48%. Conventional, it's very hard to see that right now, even with more than 700 credit score. I have one right now that I really got surprised yesterday when I was pre-approving the client, because I'm on 46.77 and I got approved. So I was like, okay, something is getting better. But let me tell you, something that really we use two automatic system, DU, desktop underwriter, and LP. I always forgot what LP stands for. But the DU is for Fannie Mae and the LP is for Freddie Mac. So when I have an application, I got an application, I review everything that I need to have, all the details of, the housing, present housing expenses. I need income, I need a proof of job, I need if they are getting salary, if they are self-employed, if they have pension, if they have social security, if they are getting child support, alimony, if they are paying child support, alimony. I have to go over the credit report because everything is showing on that credit report. So I start asking questions to be sure I do have everything. Once I do have everything, all the numbers on that application, I run the application in my system through either DU or LP. And those are the systems that are going to let me know if that person is pre-approved. Okay? I can play with that system, to tell you the truth. I can say your income is 5 million per month. I can say whatever I want. The only thing I cannot change in that system is your personal information. If your client doesn't qualify for whatever you or the client is looking for, I'm gonna start playing with the system. And I can say, okay, what if this person pays this credit card? What if this person can pay this auto loan? What if this person makes more money? What if this person goes with higher credit score? What if we go FHA? What if we go DPA? So I can have like different scenarios to talk to you and say, okay, I didn't get approved the way his or her reality is right now for the amount she or he is looking for. But for the future, if she can do this, he can do this, we can go and be there. Yeah? So that's very good about having me in-house. And again, don't forget that I want to close all your deals. I mean, I'm gonna do my best because I need money. Okay, so let's talk. Any question about FHA? Anything that you heard that you got confused or you didn't know, somebody tell you? Don't talk to people on the street, please. Because you can hear so many crazy things like, so always call me. Feel free to call me. Even if you have a question. And let me tell you, even if you have a person pre-approved for another lender and you don't understand something, call me. De verdad. En serio. Call me. I'm not gonna get mad at you. I mean, seriously. Call me, ask me if there's something that you don't understand and I can help you, I'll be more than happy. I'm always joking about, because all of us work because we need the money. But this is not all about money. I do have a lot of people that I've been working with them to help them to either fix their credit or help them to save their money. In the past, unfortunately, right now, I do not have enough time, but in the past, I used to help people to make a budget. And I used to sit with the people and say, okay, this is what we need to do. You need to cut this expense, you need to cut here, you need to do this. But that's time. I have 25 years experience in banking, so I know how the budgets work. So, but unfortunately right now I do not have that time. But I love to help people. So I'll be more than happy to help you and answer any question. So any question right now for FHA? You see, I told you I'm a very good teacher. Okay, conventionals. Conventional loans, again, they are insured by a private company. That's a huge difference between FHA and conventional. You can have up to 10 conventional loans at the same time. So let's say your primary home is an FHA. You can have a second home, a vacation home in Anna Maria Island with conventional. You can have an investment home in downtown Sarasota with conventional. You can have another home in another state with, you can have up to 10 mortgage loan with conventional. You have to qualify for it, so you have to make a lot of money. Yes, Tricia.
Okay, so you said you can't have one FHA at a time, but if I wanted to use use FHA again, can I refinance my FHA into a conventional and then go and get another FHA loan to get the whatever assistance and the lowdown?
Yes, you can do that, and I love that question, and I will tell you why. I know a lot of people believe an FHA is a government loan. Again, it's not. So a lot of borrowers come to me and they want, I want an FHA. So I'm like, really? Do you want to tell me why do you want an FHA? Because it's a government loan. Okay, let's talk about FHA. So I start, explaining to them. Let me tell you, FHA is not the best loan for your clients. It's not. Why? First of all, because it's more expensive. Also, FHA, the mortgage insurance, the guideline says if you're coming with 20% or more for down payment, you're not gonna pay the mortgage insurance. With FHA, you will pay it no matter what. Okay? So you're gonna pay mortgage insurance for the life of the mortgage. You can come with 50% down payment, you're gonna still pay mortgage insurance. So it's not always the best loan for your clients, neither for you.
When would it be good? If that's the case, when would FHA actually be good? It's just not.
If your qualifications,
I mean,
if you can't get a conventional,
exactly. If
Then-
there's not other option, because right now, and I want to talk about what is going on in the market right now. To tell you the truth, the minimum for conventional is 620, but I haven't get approved for conventional with 620. I mean, I think the lower credit score I got approved for conventional was 688. So sometimes you have to go FHA because the person qualified for FHA, the person doesn't qualify for anything else.
Okay.
So that will be the only way I'm gonna put your clients in an FHA. And something that I will tell your clients, I do not get more money if you go FHA, if you go conventional. No. So to me, it's more important to you have the best mortgage loan because you're gonna refer people to me. Yep. So that's my job. Also, people call me, oh, I want to buy some points to lower my interest rate. Oh, really? Why? No, because I want 2.875 and the person is getting 3%. And I'm like, it's not worth it. You're giving your money to the bank and your monthly payment is gonna change $10 or $12 every month. And you're gonna pay for every point is 1% of the sold price. So it's not always really worth it. Same thing, I'm not gonna sell you points just because I mean, the bank doesn't pay me more if I sell you points. I will sell points only if it's needed to qualify. Because sometimes you need to sell points to lower the interest rate to be able to qualify because of the DTI ratio. So that will be the only way. I had another client, she was getting 2.750 and she wanted to buy 3 points. I know, it's exactly like that. Oh my God, it took me like 2 days to explain to her. So, so sometimes what people say doesn't make any sense, but we have to deal with that every day. So FHA is not always the best for clients or for yourself. So every time you have somebody, again, let me talk to them, okay?
But you can get the DPA without FHA, right?
Yeah, you can get, now, the DPA and that, okay, let's see if we can go over pretty fast through DPA and FHA. DPA still is not the best one for FHA. Why? There are two different type of DPAs with FHA, the 7,500 and the 10,000. The 7,500, you're not gonna pay anything to the government. You're not gonna pay anything. You're not gonna have a monthly payment. Only if you want to refinance the loan, sell the house, or get a home equity line of credit, you have to pay the 7,500 to the government. Okay, it's not forgivable. You have to pay it no matter what. Okay, the $10,000 you're gonna pay back in 15 years. So you're gonna pay, I think it's $72.49 every month in your monthly payment. And you're gonna pay it back in 15 years. Same thing. If you want to sell your house, if you want to refinance your loan, if you want to get a home equity line of credit 5 years later, and you are 10 years away from the due date, you have to pay the remaining balance at once. They're not gonna give you installments, no, at once, okay? Conventional DPA, guess what? They are forgivable. Yes. So conventional loan can give you 3%, 4%, or 5% on sales price to help you with down payment and closing costs. If conventional allows the borrower to go with 3% down payment, when you are first-time home buyer, there's a program for conventional loan named Home Ready. Has limits in income and has low DTI, but you can come with 3% down payment and you can get up to 5% on DPA from government. And guess what? You only have to leave the house for 5 years. That's it. After 5 years, forgivable. You don't own anything to the government. Yes. You cannot refinance your loan. You cannot sell the house. You cannot rent the house. You cannot get a HELOC in 5 years. But you know how fast?
5 years.
5 years. I mean, I'm already 25 years old and I can't believe it. So, again, FHA, unfortunately, am I gonna be on YouTube and government is gonna hear my class that I'm saying FHA?
I don't think the government watches Keller Williams Realty.
Believe me, they are watching me. Oh yes, regulators are.
I'll put in your disclaimer that these are your opinions.
Yeah, exactly.
Yeah.
Please, this is Elba's opinion. It's not Bank of England.
Yeah, that's another thing, is when you're working with someone, you need to say, are you thinking that this is gonna be your forever home? Or are you just looking that you're gonna live in this for a few years until the last one goes off to college and then you're gonna build whatever your heart desires? that would make a difference too, as far as which way you would try to point them as far as what loan would be the better loan.
Yeah, absolutely. Yes, definitely. And that's why, I mean, I start talking to people, I know what questions I do have to ask. Because again, every single person is different. And sometimes they come over to me, oh, I want this, this, and this. So I ask them, do you want to tell me why do you want that? What if I told you that is not the best for you because this, and this is the reality? The other day I had a borrower, he called me and he was like, okay, I'm ready to buy a home. I tried like 2 years ago and I'm ready now. Okay, so I asked him why you couldn't buy 2 years ago. No, because my credit score was very bad and I knew, oh, you knew or somebody, a lender, a loan? No, I knew it wasn't enough. How was your credit score 2 years ago? Oh, it was 720. That's garbage. And I was like, okay. And I asked, so how is your credit score now? And he was like, now it's 750. And I was like, okay. So again, sometimes people are using Credit Karma to see the credit score. I'm sorry, but Credit Karma is garbage. So I need to run the application. I'm not gonna give you, and that is something I'm so sorry if I don't like you because of what I'm gonna say. I'm not gonna give you an opinion about a pre-approval or pre-qualification without having an application. I'm so sorry. Because every single day, every single person, oh no, I don't own anything. The only thing I have is an auto loan. And guess what?
Credit cards out the wazoo.
Or accounts in collection, medical accounts in collection. Medical bills, we don't consider a bill for a qualification. However, if they are in collection, they already ruin your credit score. So that's a huge problem. Okay? So we have to work sometimes on any way, pay those collections and try to negotiate it for those companies to remove from your credit report. We need to talk another day about the credit because there are a lot of things people don't know. Paying off an auto loan will lower your credit between 60 and 100 points. Closing a credit card, same thing. When you need to remove an account from collection, you need to negotiate first with the company because there's nothing in this system that is gonna force them to remove the collection once you pay them. So you can pay them and the collection is gonna show in your credit report for 7 years, no matter what, because they are not, once you pay them, they are not gonna remove it. So the negotiation is, okay, I wanna pay you. I wanna negotiate the balance and I want you guaranteed me in a letter that you're gonna remove that account from my collection, from my credit report. Oh no, because okay, I'm not paying you. You already read my credit. I'm not gonna pay you. Believe me, they are gonna negotiate it with you. They will. So we have to be very careful with that credit score, with that credit report. And that is something that definitely we all have something to learn every single day. It's too complicated. And as a Latin person and Spanish speaking person, let me tell you, it's even harder for us to understand the system. I've been learning for years and years and years and reading and trying to learn. I think I know a little bit, but still it's every day something different. It's very, very complicated, but it's very important, especially now, because you can have 700 credit score. You can have low DTI, but still not getting approved. Could be because you have an account that is too new. Because because you are an authorized user in somebody else's account that is in somebody else's credit card that is not using that credit card very well, because you have a child support you haven't paid. So credit is the most important thing in this system in this country.
Can I ask for just a quick comparison? Would you say that Credit Karma for mortgage lenders is like Zillow for realtors?
Yes.
So we all know that Zillow stinks.
Right.
Yes.
But one of the other things is a lot of times parents who co-sign for college student loans,
Mhm.
that goes against your credit. So even if your kid says, you know, Mom, you just need to sign this and I'm gonna be making the payments, if they're late on those payments, it goes on your credit score.
Yes. Yes.
So you always have to be extremely careful
Yes.
if you are not the one that is actually making the payments
Yes.
because that affect your credit score.
And it's hard when it's your son, because
Yeah.
that happened to me with an auto loan with my son. And unfortunately, I have to take the car,
Yeah.
from him. It's hard, believe me,
Yeah.
as a mother, and I know you, you understand me. It's hard, but he learned the lesson. So I said, you know what, if you're not paying that car, I'm so sorry, but you cannot ruin my credit. So I took the car and I went to the dealership. I returned my car, his car. I did a trade-in
Right.
and I got a lease because both cars were
Upside down.
upside down too much.
Mhm.
So I got a lease but I didn't let him to ruin my credit. So you have to be it's hard to say no to a son or a daughter, but you have to be very careful, very, very careful with your credit. It's very, very, very important. So, conventional and FHA, I was gonna say something important and I forgot. Okay, so let's talk a little bit, any question before I move? Yes.
What was the name of that program? You said the program where they have to live in the house for 5 years,
It's a down payment assistance.
but they didn't have a name,
Home
home
ready.
something,
Home
home
ready.
okay?
It's a prefer plus, I don't remember.
Isn't the home ready, what you said?
No, Home Ready is the one that allows you to buy with conventional 3% down payment. The thing is, when I'm trying to qualify a person for a DPA, I have to go, even if let's say I do have 3 people today trying to get into a DPA, I have to go in the government system every time because they change it every day, every second. They are always changing interest rate, guidelines. So even that, if I pre-qualify somebody in the morning and I have somebody in the afternoon, I have to go back to their system to be sure what I'm giving it the borrower is right. And I have to save a screenshot showing the date, because if not, if they change something, hey, this is when you have the date. Yeah, with government you have, so there's not a specific name, it's Preferred Plus, I think is the name, something, yeah. But what it changed the program is if it's conventional or FHA. And again, right now I have a client looking for a DPA and he only qualified for the 7,500. I told him, I do not recommend you that program because 99% of people regret to get into that assistance because then you cannot do anything with your house. You have to pay the government back. And sometimes, unfortunately, if you do not have the money now, probably you're not gonna have it in 2 or 3 or 5 years. So if you want to do something with your house, you have to pay them first. So it's kind of like, then people don't like it. So I try not to. Okay, FHA allows 6% on seller concession, conventional allows 3%. I think that's most of the information I have for those 2 mortgage So let's talk about pre-approval and pre-qualification. So the pre-qualification letter, and I would recommend you not to use a pre-qualification letter right now, the way the market is, because probably you're not gonna get that deal for sure, 100% sure. So the pre-qualification, basically people go to Quicket Loans, Bank of America website, Wells Fargo, Chase, and they put whatever they want. They said, I'm making $5,000 per month. I do not have credit card payments or auto loans payment or whatever. And they got pre-approved for $300,000, pre-qualified for $300,000. That's not true. Because most of the time, we don't know how to calculate our income. And roughly, to talk about income calculations, for self-employed, we have a system. Very important is sometimes, guys, you're gonna have me, if I need to pre-qualify somebody for you, you're gonna receive a phone call from me saying, hey, I need your help. Because sometimes people, especially when they are self-employed, they send me pictures by text message of those tax returns. I'm sorry, I cannot use pictures on my, and I said, listen, do not send me anything by text message. That is not secure. You are exposing your information. That's not smart at all. Even through WhatsApp or whatever. My email is protected by the bank. My computer, I cannot even access. To order that lunch, I have to go on my personal computer. I cannot access anything through my work computer because it's protected, doesn't let me. So send me everything by email because my email, my system is protected, it's guaranteed by the bank. I cannot guarantee you anything on my cell phone. So for self-employed or business owner, I need very clear copy of the tax returns because I have to scan it and run it into a system that will calculate everything for me because they are very complicated taxes. So I need that. For when you work for somebody and your client is W-2, basic calculation. Let's say your client makes $20 per hour. And let's say he makes the 40 hours per week. So we're gonna multiply 20 times 40, and then the year has 42 weeks. Okay, 52. I'm hungry. Okay, 52 weeks. So we're gonna do you have a calculator that somebody can do it? Let's do it. Let's do it, Tom. Okay, $20 for 40 weeks, for 40 hours. You see, I'm hungry.
So 800,
I'm sorry?
800.
Okay.
41,600 a year.
20,
Right, you want the annual?
no, not really. I want you to understand where that number comes from. Okay, 20 by 40 is
800.
800.
800 even?
Yep.
Okay, times 52,
So 41.6.
41.6.
600, yep.
Okay, divided by 12
Is 34.66 and some change.
34.
66, yep.
Okay, so this is your client monthly income. Okay, it's not, remember, some months have 4 weeks and some months have 5 weeks. So when the people say, oh, I make like $800 per week, so I make $1,600 per month or 32, no, this is the exactly amount we're gonna use. Now, out of this total amount, for mortgage loan, I can only use, do you remember the DTI ratio?
40.
5%.
1560.
1560?
Mm-hmm.
So out of this 1560, your client has to pay principal, interest, And if the property is in a flood zone, has to pay a flood insurance.
It's a lot.
Right now, in this market, this is nothing. 15, 16.
1560.
So why I'm sharing this with you? Because sometimes, and this happened to me and to every single loan officer, and I'm talking for all my colleagues. Don't get upset with the loan officer. We are seeing more than what you're seeing, and we know more because your client is telling us more than what they are telling you. Over time, we can only use it if they are been getting overtime for the last 2 years. So this is what we have to deal every single day. So right now, it's hard to pre-approve a client with either low credit score or very low income. And that's why if one client, one person is not enough, I can call them and say, hey, do you have somebody else in the family that can co-sign for you? DPA doesn't allow, popular we call, people say co-sign or co-signer. We name it non-occupying borrower is the way we name a person that is not gonna live in the house, but is basically signing for you or co-signing for you. It's a non-occupying borrower. DPA doesn't allow non-occupying borrower. So if you need somebody else, you won't be able to use DPA. Okay, because DPA and for DPA and all these programs, it's household income. So me and my husband, we both work. And he's the only one in the mortgage loan. The government's gonna ask for my taxes if we make them separate. If we're together, they can see my income and they are gonna go by the household income. My son is 26 years old. Let's say he lives with me, he works. Let me have your son's. If he's gonna live in the house, let me have your son's tax returns. So most of the time when there are more than one person in the house working, they do not qualify because DPA has income limits. See? So as you can see, one single person, this is something, everything in here, I have to check for every single person. I need to be sure for what loan they qualify. I need to verify the income. I need to know how much the credit score. I need to know the debts. I need to know everything here. So when you're getting a pre-qualification letter, nobody has seen anything of this. The system itself generated. So it's not true, basically. When you have a pre-approval letter, I personally have reviewed every single paperwork. And I mean, I'm a human, and that happened to me the other day. I didn't see that the borrower owns $12,000 to the IRS in tax returns. And I was like, oh my God, how come I didn't see it? And I start praying, God, please. So I called him, hey, Mr. Borrower, do you own? And he was like, no, I just paid it yesterday. Ooh. That will kill my deal. And because it's too many people, too many numbers, too much information, and I cannot keep on top of my mind every single person. So sometimes when the realtors call me, hey, Elba, okay, I'm not in front of my computer because I'm driving, I'm whatever. Let me go back to my computer, let me review it because, I cannot keep every single. It's not easy. So very important for you, and I always will tell you this. Try not to talk about mortgage. You don't want me talking about how to look for a house. Where? So let me talk to your clients. I'm gonna ask questions. I'm gonna try the best for them. And I'm gonna help you to close your deals because I need to close those deals. Are we all on the same page? Any question? Am I a very good teacher or yeah? Okay, good. So probably once you leave the room, you're gonna have a lot of questions because, oh, I forgot what Elba said about this. Oh, I should ask this. Call me. Call me. I think everybody has my business card. No? Uh-oh.
Yeah.
I get in trouble. Okay. I think I do have some of them outside, right, on the lobby. So I'm gonna give you one. So feel free to call me. If I don't answer you, leave me a voicemail. I'm gonna return your call. I'm very proud of myself because I'm very good returning calls or answering emails or text messages. If you need immediately assistance, send me a text message because if I'm with a client, it's easier for me. Or sometimes emails because if I'm pre-qualifying somebody that I have in front of me and I can see the email, I can pretend I'm still working on it.
Full double duty.
Yeah. So multitasking and the client doesn't.
So thank you for the information, Alba, and also thank you for lunch.
Oh,
very
it's
much.
absolutely my pleasure. Thank you very much for being here. I think I sent you a list. So I'm gonna try to send you some information of, everything we talked today. You probably will see because I do have these that I always kind of use for these classes, Mortgage 101. But you will see a couple of different things here, like credit score more than 580. That is not happening right now. I will let you know as soon as this start coming. So this is just, for you to have it.
Reference.
Yes, reference. Do not go by this because let me tell you this. Oh, something that I don't want to. I want to talk about it. Foreclosures, short sale, bankruptcies, they can still buy. There are waiting period and depends on FHA, conventional is different. I'm gonna send you this information as well by email. I do have your email because it's very important for you to know if the person had a bankruptcy, let's say Charter 7 and Charter 13 is the waiting period is different. So it's important for you to know. Okay.
How often can you be a first-time home buyer? I heard you can, even though you were first-time home buyer once, it's just a couple of years and you still consider first-time home buyer again, if you want to buy another house.
If you're buying your primary home, yes, but you cannot use the DPA. So there are two different scenarios. If you already use the DPA in the past to buy your primary home, you cannot use it anymore. However, you can still buy with 3.5% FHA or 5% conventional. You cannot use.
You guys can use DPA, but you can still be.
Yes,
for another
you
first-time
can
home
still
buyer
be a
program.
first-time home buyer. Yes, ma'am.
And that's after how much years? After how long?
3 years.
3 years?
3 years. Yes. Also, if you bought your house with a home ready, 3% down payment, and you want to refinance it, you can still refinance it with home ready. The interest rate and PMI is lower. It's cheaper than regular conventional. But that is something we have to decide with the application because home ready also has income limits. Okay. Nice. Thank you so very much. Thank you.